All right, let's just dive right into this explainer. We're going to unpack what has to be one of the most fascinating corporate earnings reports of 2026. We're putting Ovintiv under the microscope today to see exactly how they're just completely redefining operational strategy in the energy sector. I mean, seriously, there is an absolute masterclass in efficiency buried in this data.
$682 million. Let that number sink in for a second. That is the amount of non-GAAP free cash flow Ovintiv managed to generate in just 3 months during their second quarter. And keep in mind, this is pure cash left over after they already covered a massive $574 million in capital expenditures. Just a wild quarter.
So to really understand how they pulled off this staggering payout, we need to look under the hood. We're going to completely deconstruct Ovintiv's resilient business model. We'll look at the financial outcomes, sure, but more importantly, we want to zero in on the specific operational levers they pulled to actually make these numbers a reality.
We're going to break this all down into 5 quick parts. 1. Crushing the second quarter. 2. The shareholder return framework. 3. The power of stacked innovation. 4. Deep inventory in action. And 5. Raising the bar for 2026. Right, let's jump right into part 1, crushing the second quarter, the massive payoff.
The sheer scale of the financial de-risking happening here is just incredible. I mean, listen to these numbers. They generated $1.6 billion in cash from operating activities, beating their high-end guidance by pumping out 615,000 barrels of oil equivalent per day. Plus, they closed that massive Anadarko asset sale for roughly $2.82 billion in proceeds. Add it all up, and they slashed their net debt by roughly $3.4 billion in a single quarter. That brings their net debt to adjusted EBITDA ratio down to just 0.6 times. So they are carrying a remarkably light debt load right now compared to their earnings.
And honestly, the most crucial point comes directly from President and CEO Brendan McCracken. He highlighted that halfway through the year, they are set to grow oil production per share by 4% with absolutely zero increase to activity or capital expenditure. Think about that. Delivering that kind of growth without spending an extra dime, that is the ultimate prize for investors. It proves their underlying engine is just getting relentlessly more efficient.
Which brings us to part 2, the shareholder return framework, cashing in.
Okay, having a highly efficient machine is great, but what did they actually do with all that cash they generated? Well, they definitely didn't just sit on it. They took a massive 63% slice of that second quarter free cash flow, which translates to about $429 million in total, and handed it straight back to shareholders. You know, when a company is this confident in its newly fortified balance sheet, rewarding the people holding the stock is exactly what you want to see.
So Ovintiv actually operates on a framework designed to return anywhere from 50 to 100% of their annual non-GAAP free cash flow back to shareholders. In Q2 alone, that meant $345 million in share buybacks. That's 6.1 million shares retired right there, plus another 84 million in dividends. Year to date, they hit 45% of free cash flow returned. But because their balance sheet is practically bulletproof right now, they're actively raising the floor. Going forward, they are officially targeting 60% plus of their annualized 2026 free cash flow for shareholder returns.
So how exactly are they pulling this off? Let's get into part 3, the power of stacked innovation, the engine.
The secret sauce behind all of this efficiency is a strategy they call stacked innovation. And yeah, I know, it sounds a bit like your typical corporate buzzword bingo, right? But with Ovintiv, this is a very real, highly quantifiable culture. It's the compounding effect of using proprietary data and advanced tech, including AI, to constantly refine everything from deep technical workflows all the way up to enterprise-wide business decisions. The goal? Drive down costs and drive up efficiency everywhere. Their methodology here is so disciplined. It's really a 4-step process. First, they identify new ideas. Second, they vigorously test those innovations. Third, they scale the winning models across their operations. And fourth, this is the magic part, they stack them. They don't just find one neat trick and call it a day. They take advanced well spacing designs, AI-enabled production, enhanced chemical workflows, and they literally stack these compounding efficiencies on top of one another. It builds this incredible, hard-to-replicate operational engine that delivers seriously durable returns.
Okay, moving right along to part 4, deep inventory in action, the fuel.
To ground all these abstract financial numbers into reality, we have to look at the physical fuel powering this whole engine. We're looking at a true dual-engine production model here.
On one side, you have the highly liquid-rich Permian asset sitting at 78% liquids. They're running about 5 rigs there, expecting to bring 125 to 135 net wells online this year. On the flip side, you've got the massive scale of the Montney asset up in Canada. They're running about 6 rigs there, with 27% liquids, expecting 130 to 140 net wells. Together, these two world-class basins are the absolute backbone of their cash-generating capability. But what is truly mind-blowing here is their depth of inventory. We're talking 12 to 15 years of premium inventory life in the Permian and a massive 15 to 20 years in the Montney. And keep in mind, when we say premium, we mean inventory that stays highly profitable even if oil drops below $50 a barrel. Having this kind of deep runway on high-quality rock, it just proves that Q2 wasn't some lucky flash in the pan. This cash flow success is absolutely sustainable for the long haul.
And they definitely aren't just coasting either. Through a really aggressive ground game, they've organically added roughly 3,200 core locations in these basins since 2023. And because of that stacked innovation process we just talked about, they secured these locations at an average cost of less than $1.4 million each. So while a lot of their peers are actually watching their high-quality inventory decline, Ovintiv is out there aggressively extending their runway.
Finally, let's wrap this up with Part 5, raising the bar for 2026, the road ahead.
This is where we see the ultimate payoff from all that execution. If we break down their updated guidance numbers for the rest of 2026, they've actually raised their total production targets for the full year, now expecting up to 645,000 barrels of oil equivalent per day. Oil and condensate targets are up too, pointing to between 210 and 212,000 barrels a day. But here is the real kicker. Their full-year capital investment remains exactly the same, locked in right around that $2.3 billion mark. I mean, 4% oil production per share growth without spending a single extra dime on capital expenditures. That is practically the holy grail for energy investors. It's a direct result of that stacked innovation. They are quite literally doing more with the exact same budget.
And that really leaves us with a massive question to think about. If companies like Ovintiv are fundamentally decoupling production growth from capital expenditure, using AI and relentless tech-driven efficiency, is the entire global energy market on the verge of a leaner, smarter revolution? Seriously, if this kind of stacked innovation becomes the new industry standard, the old era of capital-heavy oil growth might just be completely over. Think about that for a minute. Anyway, thanks so much for joining me on this explainer today. It was an absolute blast unpacking this with you all. Catch you next time.